In today's video, I am going to be breaking down my top 3 recovery stocks. Most of them paid dividends. I try to aim for dividends. But anyways, let's get down and let's check out the first company that I think will be a fantastic recovery story when it comes to, of course, the economy. Now, the first company is Johnson & Johnson. Now, this one may be weird. You're probably saying, well, this was a great COVID stock, but why is it a great recovery stock? Well, let's check this out really quickly. It does have a 2.5% dividend, and I personally absolutely love dividends. Number 2 is the volume. The volume of the stock is over 8 million shares traded on average per day, which means that you can get in and out quite easily. We also want to look at the PE ratio, and it's around 30, which is a bit high when it comes to a stock like this. I would generally want it to be around 20, but again, not bad considering the potential growth that J&J and others like Pfizer may have. It has recently passed its ex-dividend date, so you won't be getting a dividend for a little bit of time. From there, what can we see in their chart? Well, we can see that it did trade for many years within a range, and so did the Canadian bank stocks, surprisingly. But what we did see was a massive hit when, of course, COVID hit. It was around $120 a share from $150. And of course, it did recover quickly, and then it started trading within a smaller range. Then we've seen a double bottom, and of course, we have had a little bit of a upswing since then. However, something that I want to point out about Johnson & Johnson is the fact that COVID is a massive worldwide thing that a lot of governments, a lot of people, doctors, and everyone are really paying attention to. For some reason, a virus is really making people really care about viruses. Remember back in the day where if you had a virus and you took a day off work and you went to the doctor would say, it's only a virus, who cares, get your butt back to work. Well, guess what? Now there is a massive undertaking by companies like Johnson & Johnson to make sure that viruses no longer exist. These shots, these mRNA shots, could literally basically stop the common cold, which is a virus, and it could totally stop any coronavirus type of transmission, because basically how coronaviruses work, the same as a flu, where it would, the actual cell of the virus will attach to a cell in your nasal or cavity or in your lungs or wherever, and it will attach to that cell and use that cell to replicate other virus the virus itself, to continue its ability to spread. That's how these things work. And with the mRNA virus or vaccine, basically it stops that from happening. Of course, it basically stops that type of virus from connecting to the cell. And essentially, they are looking at different ways as to making that totally stop happening for everything. So there won't be any more of these future flu shot type things. They could literally put it all into one, which is a potential. I don't know how far away that is, but it is something that I have been reading a lot about. Now, whether you agree with or not with the shot, it's totally up to you. I don't care. I have my own thoughts about it. But with companies like J&J, basically they're thinking of doing boosters every single year or maybe every single quarter or whatever it may be, and we're going to be essentially jabbing ourselves every couple of months. And if that's the case, you're looking at a lot of needles, a lot of vaccine, and Johnson & Johnson is one of the companies who are looking at doing stuff like that. As we can see, there is also dividend growth. We're going from back in 2016 where they were paying 80 cents per share to now where they are paying upwards of $1.01 per share. And if they start doing boosters for coronavirus shots, I can guarantee you that that price is going higher. Now, whether you like getting jabbed with a needle or not, guess what? You can get paid for it because you invest in their stock. So whether you hate the whole idea of getting a shot all the time or not, at least you're getting paid to do it. We can see that their revenue also is pretty well level. It's essentially the same amount of revenue, not massive jumps, and same as their earnings. We could see back in 2018, they must have cut back because they made massive earnings in 2018, 19, and 21. That's kind of weird. There's no 20, but whatever. That's Yahoo for you. But anyways, the last couple of quarters they have beat, and I can almost see that there's going to be a beat there because there are more and more of these shots being put out. Now, I will be going into a deeper dive into Shopify in the future, but this is the future of online shopping. It's also the future of shopping in general. These companies, these storefronts who could not be open in the pandemic had to say, oh crap, I need to get online. And because of that, they're not going to say, well, that's just a waste of money. I'm not going online anymore. The coronavirus is over. Because of course, at this point, the government can shut us down for anything. So we as business owners, we need to invest in getting online because online is technically open 24/7 unless we turn into China, where they just say, well, Google, you're not allowed, YouTube, you're not allowed. So until that happens, internet's open 24/7. So Shopify is the future. There's really not many companies that rival it right now with the platform that they have. They, however, do not pay a dividend, but I would assume that probably in 5 to 10 years, I would think that they would, especially with their growing revenue streams. Their volume is not that bad. At least this is the Canadian version of the stock, but their PE ratio is absolutely ridiculously high. However, I would assume with the growth in earnings that PE ratio will drop. We can also see that there has been a massive ramp up. Now, of course, the growth of where all of these companies needed to invest in online shopping, we've seen that growth. Now, the nice thing that I do see, and something that I really like seeing, is the fact that it consolidated and not dropped back down. The reason why this is good is because now it means that the consolidation will give us some more growth potentially. Their financials, as we can see, also have a massive growth, especially in 2020. That was their first profitable year, which is fantastic. They were losing more money, and then, of course, coronavirus hit, and of course, they did extremely well. And now, Bank of America. Now, you're probably saying, well, how is a bank able to be a great recovery investment? They must have lost billions when all of this coronavirus was happening. And guess what? They didn't. They didn't lose money. Why? Why did they not lose money? Well, guess what? They have now turned into a subscription source of revenue. They no longer really rely on interest rates. Usually, banks wanted high interest because then they could make more money. By having your money in their bank and not making real interest, they would be able to make the difference and be really rich. However, now, what they are focusing on is their ability to make subscription-style revenue. For example, mutual funds, ETFs. There is an MER that is associated with that. They make money from that. They want you to invest your money now because they can make a nice steady stream of income from your money. Just like how they would normally do with interest, however, now it's with an MER. Then, from there, what they like to focus on is, of course, the amount of money it costs to keep your money in their bank. So, for example, with TD, if you want to have a credit card, if you want a good credit card, let's say the TD Visa Gold thing, like what I've got, it costs $120 a year to have. However, guess what? If you have their top-of-the-line checking account that costs like $30 or $35, something like that per month, you get that card for free. However, you have to keep over $5,000 in that account. And guess what? If you keep over $5,000 in that account, you get a lot of stuff for free. You get a free bank account. You get a free credit card. You also get a free safety deposit box. So now they're forcing you to keep your money in there to have over $5,000, which for some people is a little much. For other people, it's not. And if you can keep over $5,000 in there, they're happy. They're giving you free stuff, but they're happy because now they can make interest off of your money. However, if you don't keep that $5,000 in there, you are now stuck with a $400 bill every single year just to have your money in the bank. So they are able to make money no matter what. And guess what? Guess who made a lot of money off of those stimulus checks in the States? The banks. So this is why I think the Canadian banks, all banks, are a fantastic choice right now, especially BMO, because with BMO, they actually have growing revenue from the United States part of the business, while other companies like Bank of Canada as well as TD actually had a decline in US revenues, surprisingly. I don't know how that happened when BMO is killing it down there, but let's get down and let's check out this stock. So their PE ratio is 13.7. It's actually not that bad, especially with their growing revenue sources. Their forward dividend is 3.75%, and that equals about $4.24 per share every single year, divided quarterly. From there, we also see a very high average volume of 2.7 million shares traded per day, so it's easy to get in and out of. Now, just like every Canadian bank, they were basically trading within a range. Anytime this happens with Canadian banks over a long period of time, that actually tells us that there's going to be a downturn. That's why when I was investing in Canadian banks for the past 2 years, I actually never put any money in over the last 2 years. I just let my money sit and invest in a couple of more growth things like Apple and Tesla at times and other things, while these were stagnated. And then I was waiting for a downturn, which we did have with coronavirus, and I was buying all the way down the table. I actually picked up BMO around there, as well as around there. Because you never want to buy all in at once, because it could still keep on dropping. So you want to buy a little bit more all the way down. And as soon as it starts going back up, and you can see that it goes up and consolidates, like we've seen here, that's when you want to buy in and get the rest of your money going in. Because, of course, there's going to be a nice recovery, which we have seen. And believe me, this is all going to happen again. I don't mean maybe next year. I mean probably 5 to 10 years from now. This is all going to happen again. So if you can keep this in your brain and say, well, as long as this is just stagnated, I might as well go with growth and then get into dividend stocks. Once the price of the stock goes down, the dividend percentage goes higher, then you're all set. And also, companies like the Canadian banks have paid a dividend and never cut or dropped a dividend for over 100 years. At least I'm talking about the big 6 banks, and BMO is one of those. So definitely, these are 3 great options for the future. I hope that you've enjoyed today's video. If you have, hit that like button, subscribe, and I'll see you guys again next time.